Let's bring in Roger Altman, founder and senior chairman of Evercore. Roger, your point is that if it is done, it's done in the issue of fairness between work and capital, not taxing it differently, because it doesn't raise enough money. But 120 billion, if it worked in a vacuum, that's a trillion over 10 years.
Well, there are a lot of debates, as Robert knows,
about whether it worked.
About whether there's a point of diminishing return in terms of the capital gains tax rate. In other words, above a certain point, it begins to lose money because investors delay selling assets. But I think I must say, I think the main argument is the one you made in terms of higher capital gains taxes, which is the same argument that Bill Gates recently made, which is that you should not penalize work.
Okay, let me ask you, was there initially a rationale that capital formation helps or
needs to be incentivized?
It's incentivized and it helps the overall economy. Isn't that what we always thought? I mean, it's sort of implied that you want people to invest long term. You want advantageous. Does it not work?
No, you're right about the original rationale.
Does it not work?
To the best of my knowledge, but remember, capital gains tax rates have historically been higher than they are now. And President Reagan's famous 1986 Tax Reform Act put the capital gains tax rate at 28%. In the 90s, which were boom years, that's where it was, generally speaking. And obviously, if you look at the economic results in the 90s, you say, well, a 28% capital gains rate didn't exactly deter activity. That was one of the best periods in American history.
I mean, we've had people in, Roger, that like Druckenmiller, who said, I don't care about capital gains. I don't think anybody cares about capital gains. But you think marginal rates are where the money is. But you also mentioned corporate taxes. So I needed to ask you, were you not in favor of lowering corporate taxes? Would you raise corporate taxes? I
was in favor of lowering corporate taxes, but not as far as they were lowered. And if you remember, and I remember this vividly, the Business Roundtable, for example, had long argued essentially for a 28% rate, at least during the Obama years. And then political forces got a lot of momentum, and the rate ultimately was set at 21. I don't think it should be put back at 35, but I think 21
it's now 19, apparently. There's a piece in the Journal today that they're averaging 19%. That's still about average. You're jonesing. What?
I'm jonesing.
Can we talk about this for a second? Do you mind? Is that okay? Can I get Roger? You sure? But can I? But can he actually answer mine? Is that that's gonna be okay with you? You sure?
I'm not that sure.
So 19 does 19 put us below the world so that our companies have an unfair advantage, or does it make us more even with the world?
Well, I think I'd have to double check the numbers. I think 19 would be a little below the industrialized.
But that's not where Willie Sutton would not go to corporate taxes either. He'd have to go to marginal rates, and not just for rich people, but across the board. That's where the money is. Well, if you really want to raise revenue, don't you need to do that?
Well, if raising the corporate tax rate to 28%, for example, that's not trivial from the point of view of the amount of money it raises. That's number one. Number two, yes, higher marginal rates on W-2 income, depends on the rate, of course, would raise, generally speaking, more money than that. And there's all kinds of debates about,
you'd have to go down.
A more fair estate tax. I mean, this is going to be a huge debate, right? Because, the core of the debate, let me just say, the core of the debate is whether you think the country needs more revenue or you don't. Even if you don't buy the idea of democratic initiatives on health, on education, and on climate.
The deficit.
I think, we have a $900 billion deficit this year, 10th year of an expansion, 4.2% of GDP. That's really a bad place to be at this late in the economic cycle.
So let me ask you a question. Would you raise capital gains rates to match marginal tax rates?
Well,
that's the fundamental question.
The answer is yes.
Yes.
But I also wouldn't raise marginal tax rates to 50 or 60%.
Okay, so I guess...
in other words, if the argument is, well, we're going to set marginal rates at 60%, do you think the capital gains tax rate should be 60%? No. I think marginal tax rates should go up, but not astronomically, and I think the capital gains rate and the marginal income tax rate should be the same.
Does the capital gains rate have to be lower than the marginal tax rate? And the question is, if you are a saver or somebody who's relying on these investments, take Bill Gates out of it. If you are somebody who is a retiree who's effectively selling equities every year to live effectively and benefiting from that capital gains treatment, Do you say to yourself, under $50,000, under $100,000, I want to keep it at 20%? And in terms of incentives, it's actually interesting, right? Bill Gates has nowhere else to put his money, so he's going to invest the money. But if you are somebody who's
well, you know, there are actually 3 tiers in the capital gains tax rate.
Correct.
And if you have a rather limited amount of income subject to capital gains taxes, the rate is lower. I think we should keep that. We should keep that, I think.
Okay.
But I mean, if you raised the top capital gains rate, for example, to the current earned income rate, maximum rate of 37%, do I think that would deter investment or deter growth? I don't.
But it's not enough money to do what you really want to do.
No, that alone wouldn't be enough money.
And to Joe's point, I mean, Democrats love this because 70% of all capital gains are realized by the top 1%. There is no more progressive tax than the capital gains. On the other hand, as you mentioned, capital gains realizations are very discretionary. The wealthy and that group can decide when. And so what do you think that break point is to where it gets so high that you just lock in investments, they don't sell, they don't generate revenue?
But that's where you have to change the estate tax. If you change the estate tax, then it trickles down and affects capital gains because people then...
Maybe, but even people who are living, if the rate is, let's say, 37% up from the current 20%, that's going to lock in a lot of investments. And you could see, even though these Democrats talk about, well, we could make $100 billion in this, you could actually see a major decline in capital gains.
I mean, I think you guys know that the estate tax today only kicks in for a couple who has
$22 million
on assets over $22 million.
Right.
I mean, that's a bit of a joke. So I think
no one pays
as part of this whole package, you have to have a ration. You either have an estate tax or you don't. And if you want to have one, I happen to think you should. That's not a rational one.
But if you don't, then it doesn't matter what the capital gains rate is. But if you have no estate tax, then the capital gains is almost irrelevant.
Almost irrelevant.
Because people of great wealth will hold on to those investments.
Right. What did you decide to do, Roger? You must have second to die, or you've got a bunch of trusts and everything to protect, because you're over that, I'm sure. So how are you protecting that for your ancestors?
Well, I hope I've done some intelligent estate planning.
So you have done it. So you're not trying to maximize your estate taxes. Personally.
Well, I'm going to pay. No, I'll pay meaningful taxis if I get hit by a taxi walking out of here.
Anything to try to avoid estate taxes?
No, all I've done is just try to, plan for my kids and be sure they have some, reasonable basis to be able to.
Because that's a great thing about having a lot of money.
But I haven't. You're asking me whether I've given all my money to my kids. I haven't.
No, what I'm asking is whether you have taken the steps that most wealthy people take to minimize their estate taxes.
I have taken a series of those steps, yes.
But wouldn't you? Would you? And you'd be happy, I think, to change the laws so you couldn't, or no?
Well,
or to make it more complicated.
Well, I think we should have a higher estate tax, okay, or a higher effective estate tax, which really means lowering the threshold at which it's eligible.
Right.
But
so what's that number? What's that number for you? If 22 million is too high,
I think the number should be something like 2 million.
2 million.
2 million.
So everything above that
should be subject to some estate tax.
Yeah.
Yes.
But also, of course, this is where the Biden idea of getting rid of the kind of step-up basis in there, right? You're just trying to get at all this kind of accumulation of untaxed wealth.
But that's not untaxed. That was taxed first time around. So we're now treading into double taxation. If you think that's okay on death,
it was unless it's sweat equity, unless it's equity in a firm that a founder started, in which case that was never taxed.
Right. Ever. Okay. But
this idea.
But we're talking about there's a lot of just taxing what you've made in your lifetime as ordinary
and the capital
income.
gains tax.
You want to do that, fine, but you have to decide. That's a different system than what we're used to.
And it's true that capital gains tax is itself often a second tax. It's a double tax.
This idea that a given dollar in the economy only should get taxed once is kind of this abstraction.
It's not a real thing.
I know. If you think personal property and things that we decided like 300 years ago don't matter, I guess.
You go and spend your after-tax dollars and you pay sales tax on it.